Hey there, Investing Iguanas. Iggy here, and today we're diving deep into the world of stock analysis. In this video, we'll be taking a closer look at Wilmar International, a company listed on the Singapore Exchange. We'll explore their recent financial performance, see what the analysts are saying about their future prospects, and determine whether this stock is a potential multi-bagger or a dud. As always, our goal is to provide you with the most comprehensive and insightful analysis to help you make informed investment decisions. We'll break down complex financial concepts into easy-to-understand terms and give you a clear picture of what's really going on with this company. By the end of this video, you'll have a solid understanding of Wilmar International's financial health and whether it deserves a spot in your investment portfolio. So, grab a snack, get comfortable, and let's get started. Understanding Return on Capital Employed, ROCE. Before we jump into Wilmar International's financials, let's talk about a key metric, Return on Capital Employed, or ROCE. This ratio measures how efficiently a company generates profits from the capital it has invested in its business. In simple terms, it tells us how much bang the company is getting for its buck. To calculate ROCE, we take a company's earnings before interest and tax, EBIT, and divide it by the total capital employed, which is the difference between total assets and current liabilities. It's like looking at how much money the company is making compared to how much money it has put into the business. Wilmar International's ROCE, a closer look. Now, let's see how Wilmar International stacks up. Based on their trailing 12 months data up to December 2023, the company has an ROCE of 6.8%. This means that for every dollar of capital employed, Wilmar International generated about 6.8 cents of pre-tax profits. At first glance, a 6.8% return might not seem like much to write home about. However, it's important to consider the industry average. In Wilmar International's case, their ROCE is pretty much in line with the industry average of 7.4%. So, while they're not knocking it out of the park, they're not lagging behind their peers either. Trends in Wilmar International's returns. Now, here's where things get interesting. Over the past 5 years, Wilmar International has consistently earned a ROCE of 6.8%. However, during that same period, the amount of capital employed in the business has increased by 41%. This means that despite investing more money into the business, the company hasn't been able to generate higher returns on that capital. This is kind of like giving your kid a bigger allowance, but they're still bringing home the same grades in school. You're putting more money in, but not seeing an improvement in performance. The risks of high current liabilities. Another thing to note is that Wilmar International has a high ratio of current liabilities to total assets, sitting at 48%. This means that the company is relying quite heavily on short-term creditors, like suppliers, to finance its operations. While this isn't necessarily a bad thing, it does come with some risks. If the company were to face a cash crunch or a dip in sales, it might struggle to pay off those short-term debts. It's like living paycheck to paycheck. It can work out fine, but it doesn't leave much room for error. Current analyst forecasts. Looking ahead, analysts have mixed opinions on where Wilmar International's stock price might be headed. According to data from Yahoo Finance, the average analyst price target for the stock is $3.68, which represents a potential upside of about 15% from the current price. This suggests that some analysts believe the stock has room to grow, but it's essential to approach this projection with caution. Analyst forecasts are subject to change and are based on various assumptions, which may or may not materialize. The business environment is constantly evolving, and new information can quickly render previous predictions obsolete. Therefore, it's crucial to conduct your own research, consider multiple sources, and evaluate your own risk tolerance and financial goals before making investment decisions. By doing so, you'll be well equipped to make informed choices that align with your individual circumstances and investment objectives. The bottom line for investors. The bottom line for investors in Wilmar International is a mixed bag, requiring careful consideration. On one hand, the company has been investing more capital into the business, which is a positive sign, but the returns on that capital have not been increasing, suggesting that the company may be struggling to find profitable investment opportunities. This could be a red flag for investors who are looking for a company that can generate strong returns on investment. Furthermore, the stock has underperformed the broader market over the past year, which may indicate that the company is facing some challenges. Analysts have mixed opinions on the future direction of the stock, with some seeing potential for improvement in margins and market share, while others believe that investors may be better off looking elsewhere for opportunities with higher growth potential. Ultimately, it's essential for investors to do their own research, examining the company's financial metrics, such as revenue growth, profit margins, and cash flow, in addition to considering their personal risk tolerance and investment goals. By taking a comprehensive approach, investors can make informed decisions about whether Wilmar International is the right fit for their investment portfolio. Conclusion. Alright, Investing Iguanas, that's a wrap for today's deep dive into Wilmar International. We've covered a lot of ground, from understanding key financial ratios like ROCE to analyzing the company's recent stock performance and analyst ratings. As always, our goal is to provide you with the information and insights you need to make informed investment decisions. But remember, investing is a personal journey, and what's right for one investor might not be right for another. If you found this video helpful, be sure to smash that like button and subscribe to the channel for more in-depth stock analysis and investing insights. And if you have any questions or suggestions for future videos, leave them in the comments below. We love hearing from our viewers and incorporating your feedback into our content. Until next time, stay curious, stay informed, and stay invested. Investing Iguanas.